The saying, you can't teach an old dog new tricks, certainly rings true in a lot of instances, but that's not the case with the CIT. Collective Investment Trusts have actually been around for almost 100 years, and they were the investment vehicle of choice back in the 1950s in the pre 401k savings plan. It wasn't until the 1980s when the tech savvy mutual fund arrived on the scene with their daily reporting that the CIT started to fall out of favor. But these old dogs, the CIT, did learn some new tricks. And now that they have been modernized to trade more easily with daily pricing and daily liquidity, we've seen quite the surge. CITs are now used in 75% of defined contribution plans. And with Secure 2.0 specifically targeting the availability of CITs in 403B plans, I think we are just starting to see the start of their run. A CIT is a pooled investment vehicle with a common investment strategy, kind of like a mutual fund. CITs clear through the NSCC, while the mutual funds clear through the New York Stock Exchange. Unlike a mutual fund, they are maintained by a bank or trust company and made exclusively for specific qualified retirement plans like the 401k. Whereas a mutual fund, any retail investor could go buy. And this is really where it matters because CITs are designed for institutional investors. They are exempt from SEC registration and can be sold directly to the client without going through a federally registered broker-dealer. This adds up to a substantial amount of savings in legal, compliance, marketing, and administrative cost. Historically, CITs have had a bad rap for slow reporting and lack of transparency because they weren't governed by the SEC. They didn't have to provide all of the disclosures. The modern day CITs know that if they want to compete with a mutual fund, then they have to match them. Market pressure, not government regulations, have caused more and more CITs to offer daily valuations and transparent reporting. More than 6,600 CITs are now listed in a Morningstar database, and many of them actually have identifiable tickers that plan participants can use to track their investments. This means that many plan participants invested in CITs can see the daily valuation and fact sheets online. Another myth is that CITs are only available for very large plans, like separately managed accounts. That's really not the case anymore. CITs can be included in the micro market plans, and nearly every record keeper has at least some CIT options available. If we just wanted to ballpark it, plans from 0 to 100 million should be evaluating mutual funds versus CITs, and plans 100 million and above would be comparing CITs to separately managed accounts. Retirement plan sponsors and committees. This is something your advisor should be talking to you about. Even if you decide these investment options aren't right for you, the committee needs to document that they evaluated any opportunities available. You should be discussing things like, does my record keeper offer CITs? What asset classes and investment strategies are available? And is there any potential for a reduction in fees? CITs were slow to adopt market and technology trends in the 80s, and they quickly fell out of favor. But now that they can play competitively with mutual funds again, it's something we should all be discussing. That's it for this week. This is Jeannie Fisher, the 401k Lady.